The three black crows pattern is a bearish three candle formation that must appear in an uptrend. This pattern consists of three or more candles with consecutive lower opens and closes. Each lower open should occur within the body of the previous candle. So this pattern shows a very visible change in momentum and a strong downward bias. Trend traders see this pattern as the establishing of a new downward trend. It's also noted that the pattern is stronger when the uptrend contains gappy price action. And here's an example of this pattern taking place in the dollar-yen currency pair. So the three black crows pattern is a bearish signal. So in our tests, we shorted the pattern on the close and then held it for 1, 3, 5 or 10 days. Running through these results, you can see that this pattern is not a particularly good one. The pattern does not do a good job of predicting further downward moves. We saw a couple of positive results, but on the whole, the average profit from this strategy is negative. For example, with a 10-day holding period, we saw an average loss of 0.5% in futures and an average loss of 0.18% in stocks per trade. In conclusion, it seems that selling into weakness is not a very successful strategy after all. In fact, you'd be better off doing the opposite. In other words, you'd be better off buying the market when you see the three black crows pattern. And if you look at the next tables of results, you can see what happens if you had done so. So here you can see that markets are more likely to go higher after three black crows than they are to go lower. I've reversed the formula so that we're buying the market instead of selling the market after the pattern. So with a 10-day holding period, buying the three black crows pattern instead of shorting produced an average gain of 0.5% across 20 markets with a win rate of 54% and an average gain of 0.18% in stocks. Next, we'll take a look at the bullish three-line strike pattern.